Hello, welcome to FreeFX. I'm Francesco and this is a Friday the 25th of November. So it's been quite a week and this is the closing of the US and all markets. So we are now at the end of the week and we had quite a lot of action this week. Very limited in terms of range, but it's very important technically, and that's why I'm going to discuss it. So I'm going to keep this short. I really want to keep it under 10 minutes and really try and compact as much as I can. Obviously there's been a lot of talk this week about technical levels, the 4,000 level being one. In my last video I talked about the options, and I also tweeted about this. There's kind of a nice neat range between 4100 and 3900 in terms of the options kind of really aggregate of calls and puts. So calls above or around 4100 and puts around 3900. That was, however, towards the beginning of the week, and now on a Friday I've just checked and I'll show you it's slightly changed from that again. So we had the options expiry week and that all happened, and then we had quite a strange week really. So from that point of view, price action very muted. So let's actually, I'm going to go backwards from this, and there's been discussions about fundamentals on my videos before, and I talked about these things before, but just kind of recapping on where we are with inflation and things, because the Fed obviously is the main motivator behind the dollar's rise, behind this year's stock market decline, behind the whole talk of the pivot being relevant or not, or just being a hype. If we look at this chart from Trading Economics, you can see quite clearly from pretty much the start of the 20th century, the inflation rate in the US has varied quite a lot. We had troughs and peaks, etc. And what's really interesting to me is not just the roaring inflation of the 1950s, you know, up the amazing levels that we saw there. We're talking roughly 20% inflation there. Now the Fed funds rate doesn't go back on this chart as far back as that, so we have to take it from around 1970. We'll pick up the story from there. And what's interesting, I've overlaid these two because you can clearly see currently, obviously, the relationship between inflation rate and the US federal funds rate. So the Federal Reserve stepping in and trying to chase after inflation to let it sort of to keep it under control. But if you look at 1970, we know that if you've read, if you've heard, or if you're alive then or whatever, your knowledge of that period will tell you that not only do we have roaring inflation, I mean higher than what we've had recently, but also we had a double peak, if you like. And there's been a lot of talk of Volcker saying that he and the Federal Reserve didn't really step in hard enough, and then they sort of raised rates, as you can see, and then started easing rates. The inflation did peak around here. I think it's something like 12% or 13% or something, and then came down and then started picking up again. So we had a decade of, well, good hyperinflation, but certainly quite high, and where it sort of seemed to be under control, and then it rose again towards 1980, and then the Fed had to sort of scramble back up, and it came up to these by current standards we might say quite extreme levels, to about 20% rate essentially, and so, you know, then it sort of stepped down from there, and it's all been quite sedate. The inflation rate has been quite sedate since then. The 90s came by, the 2000s, the 2008 financial crisis, big slump in inflation, and then the Fed trying to, you know, QE its way out of the mess, and so on. So anyway, just to show you where we are historically and what happens when you see a peak in inflation, and why everybody at the Fed, from Loretta Mester to others, saying that it's not enough to really just have one CPI data print telling you that inflation is dipping to sing the victory for the Fed and go, right, you don't have to raise rates so aggressively anymore now, you can step back, because clearly they know their facts, they know their precedent, and this can happen, this sort of double top, and it's two peaks would be a disaster, not just for the Fed, but then everybody would say, well, where was the Fed? Why didn't they do more? Well, it's now everybody's complaining that they're doing too much. So that's just one of the strange hazards of history, I suppose, short memories. The other aspect of this is that, and I've looked at this chart before with you, and just the Federal Reserve from St. Louis. So the St. Louis Fed has, on this chart, the 10-2 spread. That's the 10-year Treasury versus or minus the 2-year Treasury. So the yield spread between these two is often a predictor, if you like, of recessions. Okay, there's a big explanation here, and but you really just take my word for it if you can, because it's true. And these shaded areas here are the recessions that we've had. We, meaning sort of, well, Western countries, not just the United States, but this is for the United States. So this was the pandemic here. Previous one was the 2008 financial crisis. Before that was the 2001. Before that was the 1990 to 1991. Just by the way, this era was around the time, I can't remember exactly the year, but it was around the time when there was the Asian crisis, and that sort of brought in the collapse of long-term capital management, who prided itself of having discovered mathematical formulas and essentially a precursor to algorithmic trading, training the machines or the formula to trade in a certain way, and find sort of value in the market in a new way. So, but that will the leverage is what killed LTCM. I think the federal government of the time had to step in to avoid a total collapse of the system. There was so much invested into that, which sort of reminds me of FTX, but that's a different story. Now, time is running short, so I just wanted to pick up on this briefly because, generally speaking, if you measure these periods, so that's the 2006 October and to the start of what's considered the recession, which was late December 2007. So it's about a year plus before an effect is felt in the economy and on financial markets. So if you look at the previous one here, we're looking at sort of around April to May 2000 and the beginning of that recession of March 2001. So again, another year roughly. And I think the definition of the recessionary signal for the 10-2 spread is something like 4 to 6 quarters, which would make it obviously 12 to 16 months. But I may remember that wrong. But just measuring it here, you can see it's about a year, more or less. Now, the other really important factor here is the level of the inversion of the curve. So essentially, the curve is when the 2-year rises faster than the 10-year. You have an inversion of the curve, and the deeper the inversion, obviously the deeper the recession. So and the length and time of that inversion, how long it stays at the bottom, essentially, is very important. Now, these levels, we're talking in 2006, it was minus 0.16. And we know that the recession in 2008-2009 lasted. It's one of the longest in recent memory. If you look at this one, 2000, it was minus 0.45. Down here in 1989, it was minus 0.20. Okay, sorry, no, it's more than that. 0.43. Yeah. So my point is that this one that we're in now is minus 0.74. So nearly double what we saw in 2000 and in 1989, nearly double. Okay. And so if you have any doubts about the severity of an upcoming recession and or the likelihood of it, be in no doubt, because this is clearly, we've gone below the zero mark by a stretch. So just bear that in mind. We're coming up to 10 minutes fast. So we talked about the Fed a lot. Previously, the Fed Watch tool on the CME really is the place to go if you want a quick sort of look at. You've got a countdown to the next FOMC meeting, 18 days. But there's the other thing, 18 days to that one. However, on the 30th, which is only in 5 days, 5 calendar days, we will have a very important update which we'll come to in a second. But the probability for the next rate hike being a 75 point from 375 to 450 is 28.9% at the moment, whereas the 50 is 71%. So clearly everybody's expecting a 50. Does that mean that equity markets will find motivation to rise extravagantly in the next few weeks? I don't think so. So what we're looking for is what updates there will be on the calendar. So next week, I've just sort of filtered out the important things, if you like. On the Monday, Fed Williams speaking. Now, if you don't know much about these, you really need to go and kind of research who the different board members are from different Federal Reserve banks around the US that sit on the FOMC meetings, and which ones are voting members, etc. And then you have to sort of consider what are they going to say. Are they usually more sort of gung-ho about raising rates, or have they been so more recently, or have they been so kind of quite vocally ever since they were on the board from years on, and so on. So it's really knowing about the characters, the impact of what they say. If somebody who's usually quite averse to raising rates fast, etc., suddenly change their mind and starts advocating for more for steeper rate hikes, then that's a change in a sort of hawkish sense. So you'd have to really consider that in the context, not just saying, oh, somebody's speaking, and that doesn't really say much. But more importantly than that, we need to look at the 30th. As I said, that's when we had the chair, Powell, speaking at 18:30 hours GMT. So this might be some kind of game changer. I don't know the context of the speech physically, where he's going to be, whether it'll be a press conference or a speech as part of some sort of banking event, or I'm not sure. But anyway, it's going to be a very important update pre the next FOMC meeting, obviously. So, but as well as that, we also have a number of updates. We've got the GDP growth rate update, as you can see, ADP employment change, and we also have on a Thursday the PCE deflator, which is considered a favorite measure from the Fed to look at. Really difficult to know how to play this if you were to sort of have some kind of expectation of it to be a predictor of equities behavior, because on the one hand you can have measures that say that anything to do with consumer spending is inflationary, so you want to kind of crush the demand, and if you do that, in a way it's good. But then if the demand is too low and there's sort of danger signs of or flashing lights saying recession, would this be seen as, well, the Federal Reserve doesn't want to kind of crash the economy, so they might have to ease back a little bit on the throttle for rate hikes. So it's kind of read in a duplicitous way. It's not really straightforward. It's a little bit to be honest, it's very, very difficult to make a straight judgment on that. So I wouldn't try to front run that one in any way. So We've got other things like ISM manufacturing, as you can see. On the Friday, though, we've got no farm payrolls at 1:30 GMT. Consensus 200k, previous 261k. So maybe they're sort of slowing down of the jobs market. Could mean anything that you can read into it for price. Now, looking at positioning on the options side, this is the CME group options heat map, open interest. I set it to the open interest change rather than the actual contract numbers to see change from. So red doesn't mean more dovish, it means less of, and green means more of. So essentially an increase will be a green. So increase in puts around 3,700, big increase there. And I think I mentioned just a few days ago that it was a big increase around 3,650. So we're in that area anyway, 3,650, 3,700, which would be around here. If I can just find it on the chart, 3,650 would be around here. Yeah. So it would be around the levels we saw in late October, around there, and also in late September. This sort of floor here, 3,650 be around there. 3,700 is also these tops. That's one, and the other one is that's the puts. For calls, you need to go higher. So let's go closer to price at the moment. So price today, as we are 4,027. We've been around the 4,030 for a day or two now. So if I just go back to this and show you where we are, so we're about here in price. You can see big changes would be greens, and really big change might be around here, 4,150. There were bigger numbers around 4,100, but they sort of really just gone away, really shrunk to nothing. So this is the biggest number we see around these prices, 4,150, which is not far from where we are. And just to make it really clear, the top of this channel is kind of where we are. So 150 will take us above the channel by a stretch. It would take us to about here, okay, which is sort of around these levels that we saw before. But we should be heading lower, not higher at the moment. So I think that's probably unlikely, but that's just me speaking and hoping maybe, because I'm still short. And then if you go higher still, you might see prices above that even, with increases in calls, and that might be also very significant. So if you look at that, there's another big increase, 4,150 as I said, but really not much else. So as you can see, there's a big void there, which means there's a big concentration of option contracts around those levels, essentially 3,900, 4,000, 4,100. That sort of area is kind of where there's a lot of concentration. Now, looking at the chart from technicals, you know, because I said this before, we're in this big downtrend, and we've got all these peaks and troughs, and I've drawn that double channel for a reason. I won't go into it, but you can see that the two levels obviously being very influential, the 3,900 and the 4,000 throughout this year, from various points of resistance to points of support, etc. Resistance. Now we're at the top of this double channel, parallel channel, and this area is like a filter. So if we go past the initial barrier, that was a big CPI there in early November. So if we go past that first channel top, we go to the second channel top. And I was making a case earlier that previously we had about 5 days here at the top, and then a big collapse, if you like, and we're sort of, if we did come to the top there, 5 days and a collapse would be in order. But again, we don't know, these things don't repeat exactly, but I think we're close to the top, and so we may not have to go beyond it. We just have to see. The other important thing is that common to both really, this current uptrend within the downtrend, and this one, the July to August so-called bear market rally. Both of these, we'll call them rallies, we'll call just the zigzagging, you know, just part of the downtrend really, is to go back up and to the next top and down again, is the CCI. So I've said this to death, these three levels, where we had peaks in the CCI and then a big retreat just at the top there of the you know, I use the weekly usually for this, that's why it's slightly off, because the weekly is kind of where we're at. But I just wanted to show you that the daily gives us the divergence signals in a much clearer way. So I've just drawn these actually again, because I had them on, but I sort of took them off and put them back on in a slightly more updated way, and that's basically the first one there, and which takes about 2 weeks. If you read that from that peak, that wouldn't be a divergence per se. In fact, the first divergence was these two peaks that were very close together. So to be fair, you started seeing that divergence from here, referring to this one here. But so let's say the divergence started being confirmed here, 29th of July, and price turn at the peak there on the 15th of August. So we're looking at about 2 weeks. Okay, 2 weeks. Here we topped at this point, and then we troughed, and then we topped again roughly around the same level, 11th of November, and then we started declining whilst price has sort of gone higher. So this gap between the two dates, the 25th of October and the 11th of November, that also pretty much makes 2 weeks, and then after that we start seeing a decline. So I think this final stretch is really just so weak and the range is so small that we are definitely going to see a decline this time. There's no excuse left. I mean, look at that range. There's really nothing left in that. We've really just climbed from 3919 to now at 4034, about 100 points. Really 100 points since that CPI break. We've climbed essentially only from the 10th of November to the 25th. So 2 weeks we've climbed 100 points. It's not exactly a roaring bull market, if you like, movement. So it's been already 20 minutes. I'm going to stop there, and thank you very much for listening, and I hope this was helpful. We've covered fundamentals, technicals, economic calendar, option positioning, CME watch tool, Fed, potential rates, the 10-2 yield spread, and recessions, and also relationship between the Federal Reserve funds rate and inflation historically. I hope that was helpful, and I will see you in my next video on FreeFX. Have a great weekend. Bye.